transition that. She always wants me to wait.
Tonight on Piers Morgan Uncensored, one of the most fascinating and controversial polemicists on the planet. Dr. Jordan Peterson's books became overnight hits. Millions watch him online, and his tours pack theaters.
Okay, so I have botched this intro. I'm going to have to figure out a better way to introduce myself. You guys give me 1 second. We will let people get in here to the chat for a minute. Let everybody come in. All right, and then I got to shut that off. What is up, everybody? Welcome back to the Russell Journal. I am Russell, and this is my journal entry for Tuesday, October 4th, 2022. Today in the market, we had some different economic data come out, and most of it was good as far as the things that we need to see inflation abate. We saw about 1 million jobs disappear from the JOLTS report. Some other stuff, not so much as important as what we have here. But one of the things I want to talk about, and I want to talk about this today because we need to have some understanding of the economic environment, why we're here, how we got here, and probably where we're headed, okay? And then sort of look at that on like what kind of time frame this whole thing is going to happen. And what we want to talk about today, and I'm going to get into, is this idea of the of really the economic doom loop and the stock market doom loop, because this is kind of the direction that we're heading. And we've really been in this, depending on how you view the cycles. We have been in this loop thing for a while, since really the creation of the Federal Reserve. And this is one of the problems with a central bank and a stabilized currency and a fiat currency. So let's go ahead and break it down from the beginning. All right. Now, some of this stuff, you're going to have to check out some of the future videos I'm going to do. Tomorrow, I am going to do a video where I talk about the American economic system and kind of how it came to be. So make sure you like, subscribe the video, and come back tomorrow. Hit that notification bell, because a lot of this is going to make a lot more sense as we go on. Okay. Now, if you're not, if you're somewhat, familiar with basic economics, you really understand the kind of ideas behind capitalism versus communism. You understand socialism and where they all have faults, right? And really not to make, this is not going to be a Bernie Sanders commentary. I don't like to be political over here. I think the whole political field is a mess and nothing really good of that. And politics doesn't really make you a better trader. So I'm not too worried about that here. What I am worried about, though, is there are a bunch of different associations that people have with political views, right? If you meet somebody and you talk to them and they tell you they're a libertarian, there's a bet somewhere there that person's not going to be very happy with the Federal Reserve System, and that they're going to think that the whole monetary system is some type of thing to enslave the human species or the American public, right? That was the point of that. On the other side of that, if you go to the far left side, you're going to see them thinking that the whole monetary system is a system designed for the purpose of having the rich take from the poor, right? And if you go to the right, which is just the Republican side, you're going to find similar such fallacies all within inside of that. So we really want to start, when we talk about the doom loop, is really understand that it's just a problem with this monetary policy, this monetary system. It is not, nobody put us in here going like, well, we're just going to screw everybody and that'll be good for us. It's really good for nobody, okay? The very first thing you have to understand is at the core of capitalism, the core belief is that the rising tide raises all ships. Okay. So the thing is you go to the core of capitalism and you say, give this guy a factory and he hires employees. And as the factory makes more money, he pays the employees more money. They have more money. They go start factories. They hire employees. Those employees, right? And you have that sort of loop happening there where one guy is rich and he helps these other guys be rich by giving them jobs. They go start factories. They help other people be rich by giving them jobs, right? And so on and so forth. The problem is that within any space of that, it's limited to its economic system and usually limited to within its economic borders, okay? So things that were really going well for America, say through the 1960s, was, you know, American steel was a really good thing and American cars were a really big deal. Through the 1960s, cities like Detroit were the richest city. Detroit was at one point the richest city in the world because of their auto manufacturing, okay? So the thing here is that, like, that we can see in principle. But what happened is other countries began to produce cars and they began to produce them more cheaply, right? And also, companies that were in Detroit could go to those countries and produce cars or parts for cars also more cheaply. So instead of having factory after factory in one country continuing to raise the masses, eventually those jobs that were going to be opportunities for people on the bottom to raise themselves up got exported elsewhere. Now, the whole hope and dream for the capitalist mindset here is that if you were in a factory somewhere, you will go get a better job in an office somewhere, right? And a lot of this hung on sort of from proof of this. We had the 1930s, you had people working in farms, which was okay. Then they went to factories, which was great. And then what was the next thing for them to move into? Okay. And somewhere along the line, though, you run into a problem getting to the next level up, right? Right now, one of the sort of tropes within our economic conversation is the idea that somehow truckers are going to go learn to write computer code and go to work for Microsoft. And the problem is a 50-year-old guy who's a trucker, really getting that guy to understand calculus and the math assigned with coding for a computer is really problematic. Not to mention the guy is 50, he's got 15 years left. It's going to take 4 years to teach him to do this. And that only offers him a window of about 12 years in which 11 to 12 years to which he can actually produce income. And not to mention the cost of teaching him to do that will have to be repaid at some point, either through student loans or through government programs or whatever it is that you're doing, right? So it's really tough to spend a lot of money teaching a 50-year-old to code when you could teach a 20-year-old to code, and that person, one, is going to more easily get that, and they're going to, like, they don't have a whole lot of liabilities at 20, right? This guy at 50, he's probably got a house, he's got things to pay for, kids, family, right? So, like, it's really hard to make that transition. Whereas before, if you were 50 working on a farm and all you had to do was move to Detroit, sure, that was expensive, probably in a move some way, but there wasn't that many moving parts, okay? So we begin to see that, like, there are some core problems with capitalism, and we will talk later on about things like the middle income trap and stuff like that. That doesn't mean capitalism's a bad system and that we should all just jump on the Bernie Sanders bandwagon and do capitalism or communism or socialism or something like that. That's not what I'm saying, right? But one of the things that happens in a capitalist market is the free market. Okay. And what we want is we want a free market. We want an efficient market. We want a market that does what's in the best interest of the market. And what we want is the market to give us some type of stability. The problem with this is that it doesn't always give us stability, right? Especially across multiple regions, right? When we expand this across multiple regions. And especially also when you're dealing with limited resources and limits that are extended and it can collapse across multiple different seasons, right? Like this year's corn, we may have more than last year's corn. So it gets really hard to stabilize that. One of the solutions to something like commodities prices is a futures market. A futures market lets us sort of set up what we'll pay for something in the future. And that gives us some sort of stability that 9 months, 12 months out, we can be planning whatever it is that we are going to be consuming within the next year. And we get to that year, and the next year we're looking already next year. So we can really sort of plan around those things. One of the problems that we had in the early time of the US and with the gold standard was where the gold was and how to move it around really made the currency have a lot of problems. It had struggles, right? And what you had during this time is you had banks basically taking and creating their own notes, right? Their own paper money to use in exchange as gold and silver certificates. So that, you know, if you had gold or silver, you put it in the bank and the bank just gave you a piece of paper that verified that. Now, the cool thing was at any time you could take that note, go to the bank and get that gold, right? The problem with this is that the bank can't house all of the gold, right? That is there, that for all of the dollars all of the paper that they put out. They have to send it somewhere to store it. They're just not going to be able to sit on top of a massive chunk of gold. It's just not feasible. It takes up a lot of volume, a lot of space, requires a lot of like people to guard it and protect it and count it and make sure it's all there, right? All of those things. So what would happen is they would move for reasons this gold out to other places, to other like central banks, and then all of a sudden everybody would begin to wonder whether or not they were going to actually be able to exchange their paper money for this gold. Right. And so instead, what they would do is they would take their money, they would exchange it for gold, but the bank didn't have enough actual gold in it to make up for all the paper dollars that were currently at it. Not that it didn't have the gold, it was just maybe a couple of days away in a different, bigger, safer bank. Right. But what you would have is these massive bank runs. And by the end of the day, the bank didn't have any more gold and a whole bunch of notes to like exchange. And what you would have is a complete and utter currency collapse. Okay. This happened regularly. This was a pretty regular thing that happened. It happened about every 2 to 4 years in early America. So you get to 1913 and they really want to stabilize the currency because just like our futures market where we want to be able to plan for what's happening, you need something that stabilizes the currency. And what had been done before in Europe was with the Bank of England was they stabilized the currency, okay, through the Bank of England, right? Now, all of this is really, really important to understand because we've basically create this central bank and they have basically what they do is they have the reserves that if one of the other banks is failing, they can send gold over to that other bank, okay? And we build the stable sort of thing, right? Now, we're going to skip a whole chunk of history, and I will talk about this big block right in the middle between 1913 and 1971. I will talk about that in tomorrow's show because this is going to get really too long already. But what happens is in 1971, well, we'll say in 1940s, we have the Bretton Woods Agreement. And what happens there is we become the global reserve currency for the entire world, okay? And this is where we really take a step into what's known as fiat currency, where we're actually allowed to print more of it than we have gold, but we're still backed by gold, okay? But by 1971, things have really run as far as they can run on a gold standard, and we have to leave the gold standard because America has now become basically the bank, and all the other countries of the world are doing a bank run on us and we're running out of gold. So in 1971, we leave the gold standard completely. Okay. Now, this is really the beginning of the doom loop, right? What happens here is, and this is where you wind up in this thing where you start with a moderate interest rate, right? And things are going really good. People are borrowing money at that moderate interest rate and they're creating money. And then they're running, basically, now they have lots of money. And when people have lots of money, they buy things with lots of money. And as you buy things with them, you have less things to buy. So you have to pay more for the less things, right? We have supply and demand, supply and demand, supply and demand, right? And all of a sudden prices go sky high. So what does the central bank do? They say, oh, well, we're going to raise the interest rates. So now you guys will have less money. You can buy less things. And the people who have things to sell will have to sell them for less if they want to sell them, right? And this happened through the 1970s, through the 1980s. We had some of it in the 1990s. I remember when Alan Greenspan in the late 90s lowered the interest rate. Things were looking so good, right? Get all the way into 2008. And what you have happening is this kind of cycle where you are raising interest rates and lowering interest rates, raising interest rates and lowering interest rates. And every time inflation goes up, right? Every time we lower interest rates, that inflation rises. Now, one of the things that you have to realize is that inflation never actually goes back down, okay? The thing you realize is that inflation never goes back down. It just for a time gets to this level and stays here, right? Before it was here. And if you're young watching this or you're old watching this, if you're young, ask your older parents about when they could buy a candy bar for a nickel. First of all, it was a huge candy bar. Second of all, it cost a nickel. Now it's almost $2 for a candy bar, and it's like this big, right? It's almost the fun size Snickers, right? Or just, So the thing is like the inflation never actually goes back down. What it does is it stops going up. And what happens is the Fed can say, well, the average of inflation is only 2% over a couple of years, right? And when that happens, when they get it there, they can say, whoo, we averaged it out. It's good. We can start lowering interest rates again. But then what happens? Inflation keeps going up, right? And so you create this sort of loop within the world where you're constantly, inflation goes up, you raise interest rates, right? Then to stop it, right? So then everything's good. So we lower interest rates, inflation goes up. Then we raise interest rates, right? So it's this constant like cycle of going through this thing. Now, where this really plays out in the stock market is what we're seeing today and yesterday as far as the spikes go in the stock market. Now, there's two things about what is happening in the stock market this week that are really, really interesting. First of all, the market is really oversold, really good. As of Friday, you have one of the most oversold markets you have had in a long time, right? It's lower than it was in June. It has lost a chunk of money off of it. It is low, right? The idea that somebody with a lot of money is going to want to buy it when it is that cheap, hoping that in 10 years it's worth more money, that they're going to think that is not stupid, right? And the fact that they do want to buy it, thinking in 10 years it's going to be worth a lot more money, is also not stupid. That is a very plausible investing thesis, right? When we hit our 200-week moving average, you have the average price of the whole stock market over the last 4 years. The idea that that's not a good deal is not stupid. Now, you can look at the economic environment and say, yeah, maybe over the next 12 months it's going to go down, but that's still a pretty good price for stocks. So the idea that somebody's going to come in and buy it is not stupid. Second of all, the other thing that as we look at the stock market, the second thing that we want to see is that the market maker doesn't want the market to crash. If it crashes and goes to nothing, people are going to say that's not safe, and they're going to stop buying stocks, right? So your market makers are going to probably do a little buying of their own, right? In order just to keep the market looking good, right? So it's got to be a market, and it's got to be a marketable market. But really what comes down to is this whole idea of the Fed pivot. And this is something that I have been beating on for the last couple of weeks, okay? And the thing that I am reaching to is understanding PE ratios, understanding the earnings, and understanding what actually dictates the PE ratio, okay? The PE ratio is dictated by the cost of money, okay? It is derivative, it is a derivative of the earnings and the market cap of the company, yes, but it is assigned based on the cost of money, okay? And if you think about this as the company has cost of goods, right? They have to get so much money for those goods in order to cover their costs and make a profit. An investor has to do the same thing, okay? An investor has a cost to their money, and their return on that money for any investment has to be greater than the cost of the money. And if you don't have this, if you lose the idea that these guys are not going to pay higher PE ratios based on the cost of money, then you are mistaken, because it's a business and their product is investment. Their profit comes from the profit from the investment. And so the cost of their investment is not what they spend per share of stock. Their cost is what they spent per dollar of money, however they got it, whether they borrowed it or created it or however they made it, there was a cost to that. So when you set a PE ratio, you set it because it outpaces the cost of money, okay? So the idea that the Fed pivoting should not make the stock market go up is a complete fallacy. You need to realize the cost of money sets the PE ratio, okay? Now, it fluctuates relative to earnings because that PE ratio is to ensure that these guys are paying a PE ratio that is making the stock return more than the cost of money. The problem with this is now not just that it costs more today to have money, to make money, or to get money, that money costs more, right? The problem here is that I'm losing my train of thought here. All right, again, I've ranted way too long. The problem right here with this, right, with the cost of this whole customer thing is this keeps going up, right? And if you look back to where we talk about stable futures markets, stable currency, the currency, the cost of it's going up. It is not stable, right? And so it makes it very difficult for investors to price in, right? And money costs more. So what they're willing to pay for dollar per earnings is got to be less. And it's unstable here. So you're going to be unstable here for a while, right? If this is earnings, this is PE ratios, this is the cost of money, you're going to have instability in this right away, okay? So we're going to think about this. We're going to talk about this as we go into the charts. The idea of a Fed pivot, yes, it is not good, okay? The Fed pivoting and starting to either stop doing QT, or the idea that they're going to, if they stop doing QT or even start doing QE, yes, it is going to cause inflation. But if you're an investor and your business is outpacing the cost of money, right? It's not even outpacing the cost of inflation. They're outpacing the cost of money. That's what they're trying to do. So if this is the case, right, any stabilization in the interest rate is going to allow for a rise in stocks, because it's going to give them a respite where they can be like, okay, we can outpace inflation, or we can outpace the cost of money here, okay? And that's what they're trying to make happen. And they're trying to make it happen, and sometimes they're trying to make it happen simply before the cost of money gets even more expensive, right? So this is really, really stuff that, like, again, I'm not hearing a lot of people think about, I'm not hearing a lot of people talk about. This is what they're doing. So, coming into today, we know we got an oversold market. We got a market maker that needs to help make the market better and, and make a marketable market. You got investors who are trying to outpace the cost of money. And on top of that, you put in something like, oh yeah, you got like 90%, like what is it? 60%. The bear bull survey was like 60% are bearish. So like how many people are short, right? And they're going to have to cover. So on that side, you've got all the buyers set up to run it to the upside, whether the Fed pivots or not, right? So anyway, we're going to go ahead and jump into the charts and start to look at that. And I know I've ranted for a really, really, really long time, but I think it's really important to understand this doom loop and how it works with it, okay? Okay, I'm going to turn this on. And there we go. All right, I'm going to go into this. Okay, we go through our process. Again, trend is still up. Bias is still up. You're over the 18. You're still over the 18. Momentum. Lost the bearish embedded reading coming into the I know we got down here today. The wick hit it and we bounced off it a little bit. So momentum is down, but you're still biased and your bias is up. You've got potential price targets of the 18, break below the 18, and you'll be targeting this right here. I got to see, I can't see it on that screen. Targeting 2198 for the VIX, and upside price target is probably, go away. Upside price target is 33.69. Okay. So you're here. It's time to make a decision for the VIX. Are we going to get run in terror, or are we going to get a little more comfortable and see this rally in stocks? Now, get a break, get an open and a close below this 18, and watch out. The S&P SPY will rally harder than what you think you've seen. Okay, going to DXY. Now, I know Steve Nieder is pushing the dollar milkshake theory. I know that is happening. There's some stuff to look at here. One, we broke below the 18. So price target then becomes the lower Bollinger Band on the daily. I will say they are probably targeting that level pretty easily. Okay, so trend is still technically up, right? We've got a pattern of higher highs, and this is tentatively a higher low, unless you count that as a higher low. So I would say you've probably got a pattern of lower highs and lower lows as of right now, more immediately, especially putting that with the momentum, the bearish momentum, right? And like I said, below the 18, short bias here with the price target down here on the lower Bollinger Band on the daily. Okay. Again, this continuing to come down is going to give us some sort of respite in stocks. Okay. Coming into SPY. Now, this was good. I kind of knew this whole thing was going to happen. Again, you have lower highs, lower lows, trending down, right? But more immediately, okay, on the very short, you just took out this high over here, right? So you have negated officially the bear trend, okay? The bear trend is now gone, and what you now have is no trend. You have lower high, lower low, higher high, lower low, higher high, okay? So until this comes back in and puts in a lower low, there's really not much you can do with it. You can trade on the trend to the upside, but if this thing just shoots right up here all the way up without putting in a higher low, not much you can do with it. So trend is no trend. Bias is down. Momentum is down. Momentum, you're losing the bearish embedded reading. Okay. That's something you're losing right there. It hasn't, on mine, it hasn't officially gone yet, but it'll update in the morning and that'll be out. When it comes out, you're targeting this going right into this 18-day moving average. That is probably the first target. We will really kind of hope to see a pullback from here. And that would be very nice. Okay. Probably not a terrible idea to try and short at the 18, looking for the pullback and seeing if you get follow through to the lower low. Downside price target on this. So taking a short on the rejection of the 18, downside price target of 1. If you above the 18, upside price target of 410.66. Okay. That's going to give you kind of where you want to be. So these are really what they're probably where they're trying to get to. There is some stuff here, some resistance and other things that they need to get to, but to see SPY whip back up here to 410 wouldn't be anything. We talked about the kiss of death before. I'm gonna try and wrap this into this whole thing for you guys real quick. The kiss of death, we got it. One of the things I want you to understand is from that low, you see an average of a 9% rise. So seeing this go to 390 or even a little higher, 410 above that, is not going to be out of the picture for the rally that's typically right before the market crash. I am basically projecting that December or January, we will see that market crash. It might be the last week of November when those portfolio managers go to rebalance their portfolio. They might just yank the plug, right? That is possible. Again, we will let the chart dictate it to us and tell us what's happening when, but the likelihood of the crash within the next 90 days is highly possible, especially if we have some problems with like Bear Stearns or not Bear Stearns. We already have problems with Bear Stearns. They're already gone. If Deutsche Bank or one of these other banks really has a problem, heck, it could even be like Wells Fargo. There, I don't know. I really don't. Just we will keep our ear to the ground. I will try and keep you guys posted as far as that stuff goes. Okay. Anyway, so kind of just a recap before. Basically, what happens is they raise interest rates, inflation goes up. Inflation stops going up, and everything's good, so they lower interest rates. Then inflation goes up, right? And it puts us in this doom loop. And we're about to really take off into that because the Fed is going to do some type of pivot, whether they slow way down on like the interest rate hikes, whether they start just only doing 25 basis points or they just stop altogether, or something forces them into doing some type of QT, or QE. The Bank of England just was forced to buy pension bonds. Now, that's not exactly QE. It's a type of QE, but they bought the pension bonds. So everybody thinks, well, they pivoted. That's a pivot. And it barely is. It's not. Those guys were getting, seriously, like the pension guys were getting margin called for stupid shit, right? It's not like those bonds were never going to get paid. They're pension bonds. The guys who buy the pension, it's not. It wasn't. They weren't mortgages, right? So the thing is like the pension bonds had problems, so the bank stepped in to buy them to keep people from being homeless. Okay, keeping people from being homeless. Yeah, I guess you could argue that that's stimulating the economy, but it's really not. It's not the same thing. So it's just, you got to watch out for the tropes that are out there, the things that are out there, the hyperbole, really. With all of that being said, I am Russell List. This is the Russell Journal. We are produced. I am the writer, editor, host of the show. We are produced by Social Media Shows. Our executive producer is Maria Pureza. Big shout out to her. Thank you for all she does. If you're on your way out, please remember to hit that like. Please remember to hit that subscribe. If you can, share the video to other platforms for me. I really trying to get that 100. That my goal is to get to the 100 subscribers. and hopefully I can. It allows me to do a lot more with YouTube. So anyway, thank you very much. You guys have a good day. And pretend I said some sort of catchphrase.